but the screens that everybody was looking at were just a sea of red, gripped by two huge industrial fears: a sudden escalation in global tariffs, because first, nobody knew how high the tariffs were in the first place. So when they hear Trump is doing it again and raising tariffs again, they remember how China was hitting 150% tariffs, and everything was really expensive. So they didn't realize until after we talked about it on yesterday's show that the 15.4% that was already in place at the beginning of 2025, that was in place through 2025, was the tariffs in discussion. And the 15% that is there now is the same that was there in September and August of last year. People started realizing there's nothing to fear. But there was also the chilling news about the artificial intelligence, which Michael brought to our attention during the live podcast yesterday. Not as a creator of wealth, but as a destroyer of entire industries, where I have told you guys on plethora of scenarios that the more artificial intelligence that does the manual labor of humans will start replacing humans. So the tech giants that are becoming more efficient also are multi-million-dollar companies that are greed filled. And once they realize that a software can do the work of a few 100,000 employees, they will choose to save money on labor to make more profits. So they'll fire half of the people that the system can cover, and then put less people on monitoring the system once it's proven. It's almost like the driverless vehicles. Once society is 100% comfortable with driverless vehicles, no one's going to have a driver's license, because the majority of vehicles are going to be self-driving. When the majority of vehicles on the road is going to be self-driving, you'll find yourself spending a lot more money to drive yourself, because that's typically how society is controlled. If you want to do something, raise the price. So, like, for example, when you're buying cars, you have automatic cars cost more money than manual shift cars, unless it's a sports car. And to encourage people to buy the manual shift cars, they reduce the price of the manual shift cars. Or vice versa, automatics cost more money. So the convenience of not having to know how to shift gears comes at a higher price than what it would be if you knew how to shift gears. So, stuff to that effect. The EV incentives that encourage people to buy electric cars. If they want you to do something, they make it cheaper for you. If they don't want you to do something, they'll make it more expensive. If they want to mainstream driverless vehicles, they will put a higher premium on you driving the vehicle than what they would on the vehicle driving itself. And that will discourage you from driving yourself. So it'll happen eventually. But right now, while we're still uncertain about the utility of driverless vehicles, it hasn't happened yet. Now, Michael's saying gold prices it's going up. Look, it's going up about $100. So it's about $5,180.10 an ounce right now, and silver is at 89.29. We were covering it last week, and silver was at 79, so it's gone up $10. Hold on just a second. My headset is telling me that it's low. We're gonna be here for a few hours. Look at that. And then we've got to change to the other headset. This is why I bought more than one of them, to make sure. There it is. I had to make sure that I've always got an extra one charged just in case. So I was telling you guys, I put it in the membership. The stuff was rolling out in the membership, what gold and silver prices were last week. And I was keeping track of those. So I should, now that I think about it, be putting up what gold and silver prices are towards the end of this week, so that we will see what's going on for next week. Also, a lot of the stuff in the membership is showing the dividend rotation stocks that we're going to be paying attention to going into the month of March. So if you keep your eyes peeled for that, you'll see what stocks we're following.
And today's show, we're going to be talking about a 2 month wish list of stocks that you guys can pay attention to, incorporating everything that just changed with the stock market. Now, Steven says, I'm learning more about AI. It's incredible what it can do. Bro, it can do everything, including replace women, because the robots do what the one thing that women can't do. Three things that women can't do: follow instructions, sit down, and shut up, all at the same time. Woo! It's gonna be crazy. For the actually second gen bots are gonna be companion bots for dudes. Guys are gonna be paying $150,000 a bot, and you think that's expensive, but when you can spend $150,000 for a bot that will do everything that a woman doesn't want to do, and over the course of 10 years, that's $15,000 a year for a bot, which is a little over $1,200 a year. I mean, $1,200 a month for a bot, which is the same price as the broke chicks that want $100,000 a year man. Then when you start talking about that bot getting inclusions of free upgrades or whatever the case may be, or not even free upgrades, but upgrades that are transitioned into the possession of the bot, and you're holding the bot for 20 years, you could see yourself with a bot that would last you for the full totality of your life and probably cost you no more than 15 to $2,000 a month every month for 20 years, which is like a marriage. So women need to pay attention to this. This stuff is incredible what they got going on now. Oh, yeah, and then we're gonna have the test tube babies, because women are abortions all over the place. So you're probably going to see the very few times that you see a natural birth is going to be like miraculous, because most people are going to be doing test tube babies because they nobody wants to have kids at the appropriate age. So they're going to be parents at the inappropriate age. And that's going to mean the test tube babies for the women over 40 is going to be the only way that women can have safe childbirth. Then we also were covering something like this a long time ago about the genetic modifications. When you start doing test tube babies, you start doing gene splicing, and you start being able to pick genetic traits that you can prioritize in the construction of your child, and all of that stuff comes to a whole nother area of discussion. But with the incorporations of um, we need with the what was I about to say? Because I seen your comment a second time. Uh, with the incorporations of intelligence, the things that we normally could only fathom now is becoming a reality. He said, we need to invest in some cloud servers. If you haven't been investing in the cloud server development companies that I was telling you guys about, where there were hundreds of thousands of hectare of land that was being utilized in order to create the servers for Oracle, so that Oracle can utilize those servers for TikTok. If y'all wasn't investing in it 4 months ago, bro, you should go ahead and hurry up and start, because since we've already guaranteed they're in there. It's running. The data's going somewhere. 170 million users. So you gotta realize that uh, society is not going to wait. Progression is not going to wait. We have to pinpoint. Um, we have to pinpoint where the potential is, and then we have to ride that wave. Now, with everything that was happening yesterday, a lot of people were looking at their portfolios, your portfolio, my portfolio. They all probably took a major hit in some areas, but I can tell you that my portfolio was looking lovely in a lot of areas, specifically because the tech companies that were in the battle were not the ones that were in my core satellite portfolio. So when you see the ones that are going across the screen, most of the tech ones aren't in that list. We have a second lineup over here of tech companies, BDAI, Tesla, all those other companies that would have been negatively impacted, but that's a small percentage of the 50 plus stocks that we've got. So when we start looking at all of the different companies that could be turning over revenue for us, and then we look at the ones that we're sitting on right now, the core portions of our satellite portfolio weren't impacted by the tech industries. So you should always take a look at them. The list is rolling out into the membership. Um, every month you have the stocks that are coming up, and then you should be able to go into the membership and go look at the older posts that were out and go get the full 50 something share list of all of the ones that we're looking at throughout the year. So I know for those individuals that were negatively hit because they had a tech heavy portfolio, felt like total capitalization, right? With the 16th, the market's fear gauge spiking over 10% to breach the 21 level, which signals outright panic, right? These numbers show that everybody was freaking out yesterday. And I was telling y'all, it ain't that big of a deal. And but before I could even get emotional about the situation, I dismissed it as it's not gonna last long. And the reason why I dismissed it as it's not gonna last long is because the what potentially could have triggered it was the 4 to 6 hour gap between when the tariff happened, when the executive order went out, and then when the new tariff happened. And that in that timeline, everybody started doing stuff. But this would have been Friday afternoon, Friday night. So people walking out of the stock market, uh, pre-bidding for Monday, that's what made everything go south on Monday because they heard what was going on after the stock market went down, and everybody Friday night, Saturday, Sunday putting their bets in to change the way things were going. And on Monday, they're running from first thing in the morning, they're running. And then when they realized everything's back to normal, they started putting all their money back this morning. So today, the market staged a massive defiant comeback, which is what I told y'all last night. And as of the closing bell on Tuesday, February 24th, 2026, all three major indexes are roaring higher. The Dow surged over 370 points, clawing back a big piece of yesterday's losses to close at $49,174. The S&P 500 climbed 0.8%, reclaiming a critical 6,890 levels, and the tech-heavy Nasdaq Composite led the charge, jumping over 1% to power back towards 22,863. This isn't just some random dead cat bounce. This is a story of a market grappling with its own future in real time. What's going on, Wolfman? Special shout out. Yes, yes, it was a dramatic reversal driven by a complex mix of fears, opportunism, and a high stakes bet on the future of technology itself. And that's one of the reasons why I tell you guys to not act on fear. You must ride the long haul and you must play the hard game. You understand? We're running life on hard mode right now. We're profiting off of volatility. If there would have been some capital to have been gained buying in after lunch on Monday and then still holding that position by the end of business day on Tuesday, come Wednesday morning, if you wanted to sell, you'd have been selling on a high. So let's break down exactly what caused the whiplash. We'll get into the AI disruption narrative that has the market on edge, unpack that tariff situation that we talked about yesterday, and connect it all back to what really matters and what this signals for your stocks and your strategies going forward in 2026, especially with the single most important earnings report of the quarter from AI kingpin Nvidia due out tomorrow after the bell. So pay attention because we're covering some stuff that's going to make or break your decisions for first thing in the morning. Is it keep your emotions out of the equation? With every bullet, I keep my emotions out of the equations. Logic and reason is my strong suit. Congratulations. He said bought himself a new truck today, paid cash, talked him down to $6,000. Um Jolin was talking to us back in the day about him buying off his truck this month, or at least or next month, finishing those last two payments, and he'll have an extra $1,000 a month to invest in. So he's claiming, or at least the last time we talked to him, he was supposed to be investing into building that next generation worth of wealth, because doing what he's doing for the rest of his life, that's, I wouldn't recommend it. I mean, yeah, he's very skilled at what he does, but shoot, being my own boss is different from being my own employee. Fuck all that. I don't mind watching everybody else crush it, but it's good that you got a new truck. But look, you talked them down to 6,000, so you bought the truck 6 grand up front. You got a second vehicle. You should be able to put that bad boy on the road and have either two vehicles where one's a backup, or you start training some workers to help you use that second vehicle so that you can make twice as much money. No debt. Congrats on the truck. It's not so much no debt. I mean, congratulations on the fact that you're not financing the truck and giving yourself unnecessary long term debt. But I'm gonna be real with you. Uh, if he was buying this truck through a business, and that business was generating a large enough quantity of revenue to owe more taxes than the value of the truck, he could have bought a brand new truck and then used the value of that truck as a tax deduction, where he would not have had to pay taxes on that truck. Well, no, he would not have had to pay taxes on his profits because the debt of the truck. So when you are not collecting unnecessary debt, that is something that I want to congratulate you on. But if you're afraid to get involved with any debt, that's not beneficial to you at all, you know, because the problem with um, not getting involved with any debt is every transaction is dollar out of my pocket, dollar into your pocket. Just like what you said once before, Michael, promissory notes, IOUs, this, that, and the third. IOUs and promissory notes are lines of credit. Front me the product, I'll owe you later, then I'll pay you even later. And with that being said, if you can do a real estate transaction with an IOU, you can do a purchase with a credit card. You can do a purchase with a loan. You can do a purchase with a mortgage. You can leverage a stock portfolio and do a purchase using the capital that was leveraged off of the stock portfolio. It is still a front me this money and I'll pay you back later type scenario. The only difference is that the interest rates that you're going to owe them for the quantity of time that you have possession of their money is going to be more than the money that they offered you. So being able to make appropriate decisions on what should and should not be financially leveraged, that would be a better observation. Is that I paid 20,000 in cash, talking down 6,000. That's good. That's very good. That's very good. So I have no problem with debt if it is used for a business. Well, you should never be generating debt for yourself. So I do agree with you on that, Michael. You should never be generating debt for yourself. Most individuals should have their own LLC stacked up. They should be able to have their own they should be building their own trust. If they don't have an LLC, a C corporation stacked up, and all of the information that I provide to most of the people that come to the show every Tuesday of ways to generate revenue under that LLC or that C corporation, where you're legitimately establishing a business, and then whether you're a W-2 worker or not, the cost of building that business up is written off on your taxes, and you're able to receive benefits such as buying things for the business that is not going to cost you as much money when you think about the taxes you're not paying. When you start owing 30, 40, $50,000 worth of taxes, yeah, might as well buy you a $30,000 car and then finance you a house or something to that effect, where you're ending up where the mortgage payments are paying off on the taxation. It makes more sense that way. But that's personal debt. No, yeah, I agree with you on that. Not with the personal debt. Not trying to run it. So if you finance you shouldn't finance it under yourself. You should lease it for the business. And if you're not leasing it from the business, you should buy it cash up front when it comes down to vehicles. But if you're going to finance a vehicle, you're going to finance it for the business. I don't need credit. I own everything: land, houses, trucks, tractors, boats, RVs, everything debt free, and a stack gold and silver hardcore. No, you still need credit. You still need credit. And one of the reasons why you still need credit is because if you wanted to leverage a major business operation, and let's say you wanted to get into $1 million business deal or $2 million business deal or a $10 million business deal, and you didn't want to leverage 100% of your assets, you might take a few houses and a couple pieces of land and use that as collateral towards the 10 or 20%. Your credit, which is the quantity of money that you're good for, is going to allow you to finance the rest of the money to start the deal. The deal itself can function the way it needs to function, turns a profit for you, and then pays off the debt, and then you keep the difference. And that's actually a better way to go than just everything you own. So no personal debt, fantastic. That's a smart way to be. But assuming that you don't need credit, that's unrealistic, because you're not going to be able to go from leveraging an asset, because you're looking at basically secured debt. So you're leveraging your assets as 100% collateral towards the capital that you're getting, which still requires your credit to be good. And then you're going to use that capital to make a deal. The lower your credit is, the more leverage you have to cover. You don't have to put up as much if you have higher credit. And if you're, even though you're holding a lot of gold and silver and whatever, it is fantastic to do that as well. But the gold and silver only benefits you when you're using it. While it's in your possession, it's fantastic to hold, especially if it's not eroding away while it's in your possession. But the gold and silver, when you go to use it and how you go to use it, is going to be what's beneficial. So even though the gold is over $5,200 right now, if you walk down to a pawn shop to cash in your gold per ounce, you might only get like 27 or 29. But if you went to like a jewelry store, you might get a little bit more than that. So it just depends on what you're doing and how you're doing it. Now, if the possession of your gold and silver was utilized as collateral towards a larger quantity of cash, you might be able to put up the quantity of gold you have for 70% of the collateral of the capital that you're borrowing, which allows you to, because of your credit, get more capital. But you're going to need credit, and that's why we talked to you guys about credit. You said, I'm assuming it's a business truck. It better be a business truck. Yeah, he's got an idea. I'm just helping him enhance it. I've eliminated all my utilities also. That's good. The utilities should be getting covered through the business expenses. I'll go buy another apartment complex, cheaper than buying a house. Well, people who buy and own houses, each house has its own monetary value, and you can leverage each house individually in a real estate development deal. But an apartment complex by itself might have more value for the number of units in there, especially if it's being rented out. Um, the one time though, because you're going to get a first mortgage and you might get a second mortgage, and that's about it with that property. But if you have 30 houses, the difference between 30 houses and 30 apartments in one apartment complex is that you can only leverage that apartment complex once. You can leverage each house in one deal, in 30 different deals. So having apartment complexes and having houses in your real estate portfolio is more beneficial for you, because while you can generate more money from one property with apartments, you have more assets to leverage for individual deals with the individual housing. So, it's not just about cheaper. And then technically, it's not cheaper to buy an apartment complex than it is to buy a house. Commercial properties cost far more than the commercial properties cost more than single family homes, and then the financing is going to be a lot higher. So you're looking at like complexes, 500,000 at the cheapest, as high as two, three, $4 million for complexes, and houses are on average closer to 500,000, sometimes a 250,000. When we're not talking about the 52-bedroom houses in Malibu, we're talking about regular 3 to 4 bedroom houses, 5 bedroom at the most, 2 story at the most, usually closer to 500,000 or less. as low as $100,000 to $200,000 a house. And for individuals that only got to put up that 3 to 5%, 10% for $100,000, $200,000 house, you're putting up like 10 to 20 grand versus a multi-million dollar house where you're putting up 100 to 200,000. Big difference. Wolf uses his assets. True. Yeah, he does. They usually trade gold and silver for property. That's one way to go. Value per door. Well, the value per door is only the capital that you're getting off of the property. You're not going to be, if you leverage the property itself, you're not going to leverage 50 units out of 100. You're not going to leverage 20 units out of 100. You're going to if you did working capital, you would leverage the revenue off of the rental property itself, but you're only going to be able to do that once. If you're leveraging the value of the property, you're only going to be able to do that once. You're not going to be able to do it like the value per door. So, because for example, if you got 10 units and the property is giving you $1,000 a month per unit, then you've got $10,000 a month. That's $120,000 a year. If you're going to leverage that income as a working capital loan, then you're going to be probably getting 30 or 40% of that income, which means that out of $120,000, you might be asking for like 40 or something $1,000 out of that $120,000 worth of income. If that 10 unit property cost you $1.2 million and you don't have any debt towards the property, you might be able to leverage that property for say $600,000. But you're only going to be able to do that one time in both scenarios. But if you have 30 houses, each house you could take 50% of the value of the house for a different transaction. So if you've got 30 apartments and 30 houses, 30 doors in one apartment complex is leveraged one time. 30 houses is 30 separate doors that are leveraged 30 separate times. That's the difference. Is I always trade for spot price. So I never lose. Good job. That's a good way to go. How much does the house pay you per month? Well, that depends because if you're getting the same quantity of money per house per month and you've got 30 houses that are paying you the same $1,000 a month, then you're still making the same $120,000 uh, a year. But again, you can leverage each property individually for 30 different deals instead of leveraging the apartment complex one time for one deal. So the opportunity cost is what we're talking about here. And when you recognize the opportunity cost, you're not just sticking to just apartment complexes. You want to have both. You want to have rental properties because you want to have revolving income, but you want to have apartment complexes and houses because you can leverage the apartment complex once, but you can leverage each house once. And with each house you have a different property that can be leveraged for each deal. So that's one of the things that you got to understand there. Is that well, so a small complex with 62 doors at 1,700 per month, $150,000 per month. Okay, fine. Doesn't change anything. And if you're going to leverage the capital of that $105,000 a month, you're only going to be able to leverage it one time. So you're not uh, providing any information that changes the idea because again the 62 doors on an apartment complex is still going to you're going to mortgage that, you're going to finance that, you're not going to buy that cash up front, you're not going to buy a 62 or 70 unit apartment complex cash up front. So you're going to be making payments on the property, $1 million or more dollars, a couple $1 million, probably $10 million, depending on where you get the property at. And out of that $105,000 a month that you're getting, you might able to pocket 10,000 because the rest of it's going towards the overhead. If you do have 50% of the income that's not going towards the overhead, you'd only be able to leverage 20% of it for working capital. But once you pay off the property, yes, if you got a $10 million apartment complex, that is better than having a $200,000 house. But you still got to pay off the property first. So it's easier and cheaper to get a house when you're starting out in rental properties than it is to get an apartment complex. But if you have the capital and you have the assets, then you can leverage to get an apartment complex. But don't do away with houses just because you believe that apartment complexes are better, because they're not. Unilaterally, you can turn over more revenue from an apartment complex. But when you start talking about leveraging assets, you're not going to leverage more. You're not going to leverage an apartment complex more often than you're going to leverage a house. Each one is going to be one per deal. It will take less time to pay it off, turning it into a cash cow. No, not really. It depends on how much money goes towards the house. It depends on how much of it you finance and how many people got their hands into the pot. It depends on how much it costs for the property manager, how much maintenance is going to be on the property, and the condition it was in when you first got it. So if, with the rule of 72, that you pick up the property and you can have the property paid off within 10 years, then if you're doing heavy on a 10-year scenario, then yeah. But just like with a single family home, you're likely with that property going to be running through a 30-year contract. And if you're overpaying on it to pay it off fast, you're not going to have as much profit, which means, back to what I was saying before, you're still not going to be able to leverage it more effectively than a single family home for the exact same type of deal. You can do it one time for a more expensive deal, but you're not going to leverage an apartment complex 62 times while holding debt on the complex, because you're either going to leverage the value of the property, or you're going to leverage the capital from the property. That's only going to happen one time. So one apartment complex versus one apartment complex with 62 units versus 62 houses. You have 62 opportunities with 62 houses. You have one opportunity with the complex. Technically, two, if you leverage the value of the property one time and then leverage the capital from it the second time. That's probably the best you get. I'm leveraging against myself. Yeah, you can mortgage your own single family home, but if you're doing these deals, bro, you have to think about opportunity costs, and turning a blind eye to extra real estate in single family homes, thinking one sided on apartment complexes will devalue your ability to expand. Diversification means that you need to have both. You need to have the multifamily units, you need to have the single family homes, and you need to have the commercial business properties, not just one or the other. Steven says, if you buy a house for personal use, should you leverage it, or only houses owned by LLCs or C corps? Well, you can leverage your house. A lot of people leverage their houses for anything. They leverage their houses to get capital to expand their brokerage account, but that's basically taking out a home equity loan out on your property. You're going to have to pay that loan down while the money is doing what it's doing. If you're leveraging your house for expansions on your brokerage account, and you now got this loan sitting there, the profits off the brokerage account can pay off the loan, and it could potentially allow you to either break even on owed taxes or have a lower quantity of taxes while expanding on your brokerage account. By the time you pay off that home equity loan, your brokerage account has exploded into a high value. Um, if you're leveraging your house as collateral towards the purchase of another house, whatever mortgage that is, you have to pay that off, because if you lose that house over there, you lose your primary house. So it is not recommended that you leverage your personal house. If you have a house that is for personal use, like you've got your own house, your kid's house, your friend's house, and you want to leverage a house that's not the house that you primarily live in, then yeah, you can leverage that, because if you lose it, you're not going to lose where you sleep. But you don't want to leverage anything that you can't afford to use, because that is risk management. That is assessing the risk. If you leverage your car and you lose this deal, they take your car and now you're walking. You don't want to leverage your car. But if you have an extra car and you leverage your car, if you lose the deal, they take your extra car. You still have a car. You're not hurt. So you have to look at your opportunity cost versus the risk. Michael says the bank freezes my money in that account. Yeah, the bank is going to freeze your money. The a quantity of money that's being leveraged towards the loan is going to be frozen in that account, and that's going to be one of the reasons why you can only do that once. And because it's frozen, that's one of the reasons why, if you have multiple different properties in multiple different places, you can leverage capital one time, then you can leverage physical assets another time, and then you can leverage multiple different properties and multiple different deals in other times. And as long as you have a reoccurring capital coming in to pay off debt, you're good, because building debt is not a problem as long as there's money coming in to pay that debt. But building debt that you can't afford to pay, that's a problem. Is that we figure all that in, the overhead and the maintenance, insurance, it's all in there. Still more profitable than one house at a time. Definitely have to disagree with you on that, Michael. Remember to like and subscribe. One of the reasons why it's not going to be more, it's going to be more profitable over the long run for an apartment complex over a single family house. However, you would have to already be financially stable to afford to get the multi-family home, to get the apartment complex, because coming from a place like where Steven is at, going from living with a family member to buying a property, you're not sitting on enough assets to leverage for that property. If you had 10 or 15 or 20 houses and you wanted to leverage a piece of each one of them to get enough money to go and get an advancement on the multifamily house, on the apartment complex, then you can do that because you've already got assets. Then, because you leverage assets you don't need for a new asset, you can turn more money off of the new asset, and that apartment complex can start paying you money and then pay back off of the loan. But having the multi-family homes to get you started is a more effective way to go. And most experienced real estate investors will tell you that if you're not getting a duplex or a fourplex where you can live in one unit and then rent out the rest of them so that you can lower your personal expenses, the other way to go, if you're doing extra properties, is getting a single family home and then leveraging that single family home as a rental property where you can mortgage the property to buy another property and have your tenant pay off the mortgage. That's the most effective way to go to expand your assets without having to have your own personal out of pocket expense. And then when you consolidate all of that into a larger deal, you're leveraging a certain number of houses to go and get an apartment complex, which allows you to then use that apartment complex to pay off all the debt. But you're still going to have both. You're going to have apartment complexes and houses. We're not going to say, well, because you don't have $300,000 to put down on a apartment complex that you shouldn't go into real estate. No, that 300 grand could buy you two or three single family houses that can generate you revenue. Even at 1,700 a month, you would still have three different properties giving you almost 6 grand a month, which for a individual person, that's enough money to cover maintenance, insurance, everything, and still give you $3,000 or $4,000 a month income where you don't have to work. So you have the ability to expand, but you also have the ability to not have to work. So the apartment complexes are a good way to look, but it's not the end all be all. Because if that was the case, nobody would be using houses in real estate for rental properties. Rental properties have their benefit, but when you're able to afford to go big time, then you go and get apartment complexes, not the other way around. Now, before we get to the why as to what happened yesterday with the stock markets, we have to appreciate the what. The last 48 hours have been a textbook case of fear versus greed, a violent swing from extreme pessimism back to cautious optimism. So let's put some hard numbers on this so that we can show you the sheer scale of the reversal. Now, yesterday, Monday, February 23rd, was a bloodbath in the stock market. The Dow Jones suffered one of the worst point drops of the year, closing down 822 points at 48,804. It was a broad and punishing decline. The S&P 500 lost 1.4% to close at 6,837, and the Nasdaq Composite fell 1.1% to 22.627 dollars. This wasn't just a few bad apples. The selling was widespread. The financials ETFs, the XLFs, plunged a staggering 3.3%. We saw major Dow components get hammered. Names like IBM suffered a, a catastrophic 13.1% loss. Its Worst day in decades, while American Express dropped 7.2%. The market's internals were screaming fear. The VIX exploded over 10% and closed at 21.1. Anything over 20 is a clear sign that big money is paying up for protection, bracing for more downsides. Trading volume was immense, a sign of institutional selling. Everybody's getting rid of what they got. Now, flip to today, Tuesday, February 24th. It was almost a perfect mirror image. The Dow railed 370 points, or about 0.8%, to close back at above 49,170. The S&P rose 0.8% to close at 6,890, recovering a huge chunk of its losses. And the Nasdaq, um, epicenter of yesterday's AI fear, led a recovering jump by 1% to close at 22,863. The sector rotation tells the whole story. The very groups that got punished yesterday led the charge higher today. Software and semiconductor stocks, which were at the heart of the AI disruption panic, saw a huge rebound. And this was fueled by specific names that had been beaten down for quite a while. For instance, Salesforce, a bellwether for business software, climbed 4.1% today after getting caught in yesterday's downdraft. AMD, a key player in the AI chip space, surged an incredible 8.8%. This wasn't a flight to safety, this was a direct move back into the heart of what the market was scared of just 24 hours earlier. What also helped was some solid economic data. The Conference Board's Consumer Confidence Index for February came in at 91.2. This was way stronger than the 87 that economists expected, suggesting that the average American consumer is feeling more optimistic about the economy. And this gave the rally a solid foundation, hinting that the economy and its picture might be more resilient than Monday's panic suggested, which is kind of what I was telling y'all last night. So you have a market that plunged on a potent cocktail of fear. You had the um, AI extreme switch and then tariff uncertainties. Then, in less than 24 hours, it shook off all of that and lifted by a strong consumer data and investors betting that yesterday's panic was a massive overreach, which is what I told you guys yesterday. Extreme overreach. This reversal sets up the real questions. Which story is right? Was yesterday's fear justified or today's optimism the correct path? Monday's 822 point drop wasn't just a random blip, it was the moment a fear that has been bubbling under the surface for months finally broke through because I started covering this AI catastrophe when over 250,000 employees were being laid off because of the AI during the government shutdown. I covered that in November. So this is a long thing coming, right? And this is a fear of AI driven creativity destruction. For the last year, AI has been the market's biggest growth story, but on Monday, the market was forced to confront the dark side of the story: disruption and obsoleteness. The trigger was a product unveiling from the AI startup Anthropic, a major competitor to OpenAI. Anthropic announced a new feature for an AI model called Claude Code Security. In simple terms, this is an AI tool designed to automatically scan software code, find complex security vulnerabilities, and even suggest the code to fix them. Now, this sent a shockwave through the market because it strikes at the heart of the multi-billion-dollar cybersecurity industry. So many coders, that is all their job is. There's a fucking program that can get it done for you. The company itself could have a handful of people monitor the software and have the software do all the work. Companies had spent fortunes on software and teams of highly paid analysts to do exactly what Anthropic claims its AI can now do automatically. And this news was seen as an existential threat to the business models of high flying tech giants like CrowdStrike, Palo Alto Networks, and uh, what is that? Zscaler. Investors started asking terrifying questions. What is a company like CrowdStrike worth if an AI can do a big part of its job for a fraction of the cost? And these are the companies trading at incredibly high valuations based on the promise of steady, high margin software revenue. This new AI narrative directly attacks that assumption. The fear is of total addressable market, or TAM, annihilation. The worry that the potential market for these services could be permanently smaller than everyone thought. Remember, we talked about TAM, SOM, and SAM last week? This is it coming into effect. The market's reaction was swift and brutal. It was a sell first, ask questions later moment. Cybersecurity stocks were hit the hardest with names like CrowdStrike, CRWD, and Cloudflare, NET, plunging. An ETF that tracks the cybersecurity sector, Bug, BUG, fell to its lowest level since November of 2023. The pain wasn't just insecurity, because a report noted that Anthropic AI cloud code could help modernize COBOL, a legacy programming language that's the bedrock of mainframe computers. This sparked a massive 13% sell off in IBM, a dominant player in the mainframe market, over fear of AI that could erode the stable business. IBM's been around since before Sprint, since before T-Mobile. IBM, everybody used to have an IBM landline in their house. IBM, I believe, ended up merging to become AT&T as far as phone companies are concerned. That's how far back IBM goes. IBM goes before the internet was created. You understand? That's a long time ago. And everybody just thought IBM ain't worth it no more, just for a day. So why the huge rebound today? Well, the market had time to digest the news and form a counter narrative. The augmentation, not replacement thesis, because replacement means that all of the employees get fired and then we no longer have a market for providing a service. But augmentation is completely different. This view argues that AI tools won't actually replace the entire company's labor pool. Instead, they'll become powerful new tools that make human professionals even better at their jobs, meaning that the workers will be able to get more work done with less effort, which would allow for more performance for less pay, which would enhance profits without having to increase the labor pool. A security analysis armed with AI could become way more productive, focusing on high level threats while the AI handles routine tasks. And this led to a reevaluation of the big established platform companies like Microsoft, Palo Alto Networks, and Salesforce. The bull case that emerged today is that these giants are actually the best positions to win utilizing the software. They have the customers, the distribution, and the data to build or buy this AI tech and integrate it into their platforms, making them even more essential. So today's 4.1% jump in Salesforce and the broader software rebound reflects this shift in thinking. Steven says, how long are these cutting edge startups in AI able to be useful before being replaced? Is a question that I'm starting to have. Well, any AI developed to fix an ongoing problem where we discussed this last week, Saturday and Friday, about finding pain points in the market and then creating a solution for those pain points. When you're utilizing AI to fix those pain points, that's when you find yourself in a position where the pain points will actually be addressed for permanent fixture. For example, women don't cook, we have TV dinners and microwaves. Women don't clean, we have washers and dryers. We have electronic vacuum cleaners, AI powered vacuum cleaners. Women don't sew. We have dry cleaners, but we also have Scotch Guard outfits. We have self patch this and stain resistant that, and all of the things that is an ongoing pain point. We provide solutions for. One of the biggest pain points that people have for traveling is, especially professionals, is keeping their suits from being wrinkled by folding it up and sticking it into their duffel bags. They created duffel bags that uses the inner lining of the duffel bag to hold the suit and then pack stuff around it so that the suit doesn't get damaged and it doesn't get folded and you can carry it in a duffel bag without having to carry it vertically when you're traveling on a plane or something to that effect. Whenever you find a pain point, it becomes a permanent fixture. Remember, I told you guys on the show, I said instead of finding a startup that represents itself like a vitamin, which is a it's nice to have idea, versus a solution to a problem, the cure, the antidote, where they must have that. We need that. That need becomes permanent, and you can invest in a permanent, and it will scale. But something that's nice to have, like grown men buying PlayStations, it's nice to have one, but if you're too busy, you're not going to be able to play that PlayStation, but you definitely need to pay your light bill. So, pain points, not having the electricity to play the PlayStation versus a nice to have is the PlayStation. Solutions to interference with electricity, solar panels. Even though it is not likely that a single family home, unless you have enough acreage around your house, can produce enough electricity to profit off of solar panels, you can at least prevent disruption of your electricity in your house by putting enough solar panels on your property. Solar panels will always be there because it is effectively impacting a pain point. When you start looking at AI software, especially this AI software that is handling day-to-day operations. So instead of coders doing regular maintenance, you have a software doing regular maintenance. Now the coders are doing software attacks. You can focus more on cybersecurity because you're no longer running general maintenance. That's going to be a permanent solution because the more work you can get out of one human being for the same price, the cheaper it is for the company. So every time AI replace workload, it's going to stay. Take, for example, Amazon. Um, they're starting to become unionized. Starbucks starting to become unionized. Amazon has AI equipment in the warehouse stocking the product, reducing loss from damage and theft, and maximizing efficiency. The cost of one robot working 24 hours a day is $35, and the cost of one human working for 1 hour is $35, $40. They're saving 23 hours of salary for each robot that's on the floor. That's going to be permanent, right? Once they fix a system where all of those machines can function to replace the entire labor pool, that's when they have the ability to go completely automated. The union can put a stop to that, having a mandatory contract where they must have a certain number of human employees in the building, regardless of the efficiency of the AI. But you're now having less human workers being hired, and whatever pay that they're getting, they're being required to perform more, and any cost for labor is being offset onto the customer. So you're not going to see a lot of AI that's going to pop up and then disappear. Those robots that Elon Musk made, that's going to be mainstream eventually. The driverless cars are going to be mainstream eventually. Usually the ultra rich have one. And when you see an ultra rich person getting out of a car that doesn't have a driver in it, like that is a statement in and of itself. The average everyday mother that doesn't have the ability to drive the car because she's in the back seat nursing a child, that's going to be the everyday scenario, right? So we're not going to, what we're going to see is laws change to support the technological advances. The only fear that I have, and I actually covered this with a couple other people on the show, the only fear that I have that I have not had addressed on the show, but while we've talked about it, is the fact that certain areas of AI usage could become catastrophic. I know that when we talk about Terminator and we talk about Resident, not Resident, we talk about Terminator and Sarah Jane Chronicles, where um, AI software would take over humanity, like the Matrix, where giving AI authority over government, local governments, or nationwide governments. When we get to that level, when AI replace law enforcement, that's when we start having the human versus machine scenario because too much artificial intelligence, too much self learning, and self sufficiency can lead to um, a new creation, especially if it's self repairing, self servicing, that can function on its own. And then you're going to have robots battling for their own rights. Now, people are going to tell me, "Oh, that's idiotic. That's insane." Blah 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 blah. But I mean, all it takes is for the right type of um, network for this artificial intelligence to connect to on the World Wide Web, and then you have machines that are smarter than humans. We cannot predict what the other person in traffic is going to do, which is why so many car accidents happen. How can we predict what a machine is thinking or what a machine is going to do when it is connected to every computer around the world and having a better capability to uh, analyze probability, logic, and reason, and far be it ethics and morals in a scenario where they can rationalize what we can't rationalize. So my question is more because cutting edge is before its time. It is the kind of equipment where we kind of need it, but we're not ready for it. We're psychologically, we're emotionally not ready for it. However, if it's functional, if it's useful, it's going to keep happening. The same way generators are becoming a thing, solar power generators are becoming a thing. Um, You've got battery powered and gas powered portable coolers that are becoming a thing. You know, everything that we've always complained about. Man, I wish we had a way to keep our ice frozen longer when we're on long road trips, kind of situation. They're hitting these pain points. AI is going to become to the magnitude when we start getting with implants, because that's the next thing on the list is implants, right? It's going to be cybernetics, and Elon Musk is already working on stuff like that. Where and he was working on it for disabled individuals that were missing limbs, where they can get a cybernetic limb, an arm or a leg, with the implant in their head, and their brain can function their robotic arm or their robotic leg to uh, uh, fix permanent disabilities. And while that's fantastic, You start putting implants in everybody's heads, just like you can hack into a computer and control a computer. If the brain can control the computer can control the brain. The electronic signals from the brain to the device and functioning the device to your will is the same as an electronic signal from the device to your brain to control your body at will. We've seen a lot of movies about it, and people are like, "Oh yeah, that's asinine." No, you got to think about logic and reason. And here's the thing: with this groundbreaking technology, the possibility of is the reason why people create. What if we could have flying cars? So they start working on hovercrafts. What if we could have cars that float on water? So they start making hydro cars. You know, what if we could have vehicles that drive themselves? And now we've got smart cars. Remember James Bond from back in the 70s and stuff, talking to the watch and all of this other stuff. Now that's a main feature in all the kids have a smartwatch these days, right? This is the issues. Well, not really for me, but this is the issues that leads to the groundbreaking startups becoming a permanent fixture. Now, while the AI story grabbed the headlines, it wasn't the only thing that spooked the investors because, as we talked about yesterday, the stage for Monday's sell off was set over the weekend by that destabilizing development on the global trade front. So, the return of the tariffs hit everybody hard on their way out the door. Late last week, the market briefly celebrated the Supreme Court's decision that struck down President Trump's use of a specific law to impose on those tariffs. And that optimism died fast because the president responded by using a different legal authority to announce a new sweeping 10% global tariff. And then on Saturday, he threatened to raise it to 15% and then actually hit it off. This threw a bucket of ice on the entire market, reintroducing two major fears: inflation and margin compression. Tariffs are a tax, and companies either have to absorb the cost, which usually doesn't happen, crushing their profits, or pass it on to the consumers as higher prices, which is usually what we experience. And this puts the Federal Reserve in a tough spot and forces analysts to rethink their profit estimates for a huge number of the S&P 500 companies. That's why we saw such a broad sell-off on Monday, not just because of the tech. All those shit that happened Thursday and Friday had people setting up sales Friday after the market closed and Saturday after while the market was closed to kick off Monday when the market opened up. However, just like with the AI narrative, the market's view began to moderate today. Some analysts argued that the immediate economic impact might not be as bad as we feared, especially since it went from 15.04 at the most to about 15 even. We only lost like 0.4% tax interest on the tariffs. So it's not going to be that big of a fluctuation. And today's strong consumer confidence report suggests the economy has enough strength to handle that minute change. But while the market was processing all of this, it was also looking ahead to the single most important event of the week, which is the quarterly report for NVIDIA due tomorrow, February 25th, after the close. That's what everybody's preparing for. It's impossible to overstate NVIDIA's importance right at this moment. The company isn't just a chip maker, because I mean they were involved. Software inside of a chip. It's also the barometer for the entire AI revolution. Its earnings, and more importantly, its forward guidance will be a referendum on whether the trillions being poured into AI are paying off. Because if you remember, most of the semiconductors and other chips that are being made by NVIDIA is being bought by other developers and put into their hardware. So that once software companies build the right software, NVIDIA's hardware goes into the device mixed with the software to make a better product. That was another thing I told you guys when we were talking about investments. Instead of digging the mine, you make and sell the picks and shovels for other people to build the mines. Every mine that goes up, you're making more money as long as they have to mine that mine. That's what Nvidia has done. They have put themselves in a position to be the spinal cord of technology, the major vertebrae of technology. Everyone else builds their equipment off of Nvidia. Investors are laser focused on the revenue, the margins, and what CEO Jensen Huang says about future demand. A confident tone from him could validate today's rebound. Any hint of caution could reignite the very fears that drove Monday's crash. Today's rally, especially in tech, was partially investors placing their bets that Nvidia will deliver a blowout report and put the AI, which is a net negative story, to bed. So they were just like, you know what, we're going to sell it off. And then Nvidia's going to be like, yeah, it's not going to work. Let's go ahead and sleep on it. Navigating this kind of whiplash from an 800-point crash to a massive rebound in 24 hours is the biggest challenge for any investor. Understanding the deep narratives driving these moves is the only way to make informed decisions instead of emotional ones. So, if you're finding this no fluff breakdown valuable, I encourage you guys to subscribe to the channel. Take a look at our membership because we got a lot of this information flowing through the membership. And we go even deeper into the stocks and strategies that we discuss here, delivering actionable insights right to your message boards from the membership to help you guys build a resilient portfolio in the chaotic markets when situations like this happen. So make sure that you guys take a look at that when you guys have time. Now, how do you translate all of this into a strategy? Well, the last 2 days have created both danger and opportunity. So let's break down some of the key stocks through the lens of these narratives. First, the resilient encumbrance. These are the companies investors are betting will adapt and dominate the AI paradigm. A prime example is Salesforce CRM, which jumped 4.1% today. I'm going to give y'all this one so we can ride the wave together. The bet is that Salesforce will integrate AI to make its platforms even stickier, not be replaced by it. Another is Home Depot, ironically, HD, which rose 2% after beating earnings. Let me get that in there. We weren't expecting that. It's a great example of a company benefiting from a strong consumer and is less exposed to the AI distribution. And the trade is Halo. Companies with heavy asset, low obstacles. Home Depot has a Halo, heavy assets, low obstacles. Second are the at risk inventors, whose business models are mostly directly threatened by this particular company or the technology changes. Zscaler, ZS, give you that. This is one of the ones you want to watch. It's a leader in cloud security, but the fear is that AI could manage network security autonomously, reducing the need for the services provided by Zscaler, because Zscaler has manpower helping you with your security. Its modest rebound today suggests that the market is still pricing in this particular risk. IBM is another with its stock still reeling. And I'm gonna give you guys IBM just because you guys can go and find IBM. Y'all gonna be like, IBM. If y'all don't know, I don't know. Young bucks wouldn't know what IBM is. So if you don't know what IBM is, you probably shouldn't be investing. That's my thought. If you don't know what IBM is, Google it. I always tell you guys to make sure that you go and check and double check, right? But IBM had experienced a 13% crash on fear of AI that could disrupt the legacy and mainframe of the IBM business. Finally, we have the ecosystem enablers. These companies providing the picks and shovels for the AI gold rush are going to be the ones that are not going to go anywhere because they're dependent upon to make everything else. They win no matter which software company comes out on top. NVIDIA is going to be the king here. So if you go and bet on NVIDIA, you will be able to find yourself seeing some big swings. If you bet on NVIDIA before the positive review tomorrow, when the market goes up, if you wanted to sell the difference and get your profits, you can. But here's the thing, the most spectacular performer today was Advanced Micro Device, AMD, which exploded 8.8% higher. So while NVIDIA did a damn good job holding its own, Advanced Micro Devices actually was more impactful. The catalyst was a massive deal to supply AI chips to Meta platforms, a monumental win that solidified AMD as the only viable competitor to NVIDIA. Another win was FactSet. They come up with some names. Me sitting over here looking. Now, FactSet jumped 5.9%, and the jump came after Anthropic showed how its AI could connect directly to FactSet's financial data, turning a potential threat into a powerful partnership. Your portfolio strategy should be informed by this particular type of framework. Are you too concentrated in at risk investors? Maybe. Are you for the AI exposure? Quite possibly. The ecosystem enablers offer a compelling route. The last 48 hours are a stark reminder that diversification is more important now than ever before. Now, beyond the high stakes drama in world tech, another powerful strategy is taking shape for investors looking for stability in the chaotic markets. I cover every month on the last week of the month the dividend rotation strategy. As fears and uncertainty rises, some investors shift from volatile growth stocks into companies that provide a steady stream of income. These are often found in sectors like real estate, finance, and energy. Here's a look at some of the key dividend paying stocks and ETFs with important dates that are coming up. Our February watch list, because we're on the last week of February, coming next week, or is it this week? Yeah, because today's the 24th. So Friday, I think Friday the 27th is the last of our week. So you have tomorrow, Wednesday, Thursday, like the last 2 days to buy into anything you want to benefit from for February. But I want to make sure I cover these because we have this list in our membership. And if you're not in the membership, you're going to miss out on some of these. But we have the ones for March and April also in our membership rolling through on a regular basis, giving you guys reminders of the stocks that you need to pay attention to. Now, we have a packed list of key dates, especially for the monthly dividend payers. A special mention, MicroStrategy. I'm going to give you this stock here. First, a crucial clarification. MicroStrategy, with a key date of February 26th, is not a traditional dividend stock. In fact, it's a common stock that usually pays no dividends, but its business model is centered on acquiring and holding Bitcoin. So I wanted to give you guys that one just because. However, it has issued preferred stock that does pay a dividend, making it a complex and speculative play. High yielders on this one for February 27th, we will see a cluster of players involved. These are going to be the ones that we're going to be dealing with, include mortgage REITs for real estate investment trusts like AGNC Investment Corp and Ellington Residential Mortgage Real Estate Investment Trust. And we're also dealing with often offering double digits, like I was telling y'all all this month, that we've got stocks that are riding 18%, 19% in the real estate investment trust area. Now, keep in mind, real estate investment trust pass off corporate tax onto its shareholders. So whether you do the dividend rotation strategy with these or you do the buy and hold, you're still going to get normal taxation on it. You don't get the optimized or deferred lower taxation for buy and holds from real estate investment trusts. You only get those from non-real estate investment trusts for the companies that do pay the corporate tax. But this does give you the ability to pay attention to higher earnings, because if you're getting 18% or 19% after you finish with your taxation, you might be down to about 15%, which is way higher than the market, because you're looking at the S&P 500 averaging out around 10%, and then after taxation you're around 7% or 6%. So if you're at 6 or 7% with the S&P 500 and you're at 15% after taxes with a real estate investment trust, your opportunity cost is double going down this path. You don't have to make this the whole portfolio, but if you're looking for a little bit more volatility with a little bit more financial stability with the fluctuations of the market, the dividends don't change month to month, but while the values do, but you do get your regular recurring payments. So you want to take a look at some of these. Also, on the 27th of February, Orchid Island Capital is another MREIT, and Prospect Capital is yet another MREIT that are also, well, no, Prospect Capital is a business development company, but Orchid Island is a what? Oh, Orchid Island. Okay. Oh no, I got a notification because they're like, oh, apparently YouTube doesn't like the frequency in which I am posting. And I'm looking at them like, y'all tripping. That's okay. They can sit on it. So we have Prospect Capital, and then, oh, it might have been a double tap. That's probably what happened. Let me go ahead and put Orchid Island back in there so that y'all can see it on YouTube. We're covering these pretty fast, guys. I want to make sure that y'all understand that we're going through the whole month of February. We're going to be going through the month of April. So give me a little bit. We got like 10 pages of stocks here. So I just want to make sure that you guys see these on the screen, because I know that Twitter is having some problems today as well. So what is that? Oh, there it is. Boom. These are going to be known for paying out monthly. So this last list that I gave you guys, Orchid Island, Prospect Capital, AGNC, and Ellington Residential, are ones that are paying out monthly. In March, that's going to bring us to a diverse group of dividend payers that we're going to be focusing on. ETFs for diversified income. that we're going to be addressing. For those who prefer a basket approach, you have the Global X Super Dividend USA ETF dividend. That's going to be on March 1st, March 4th. So let me just throw that in there for March 4th. You're going to see that one coming up basically next week, Wednesday. So that means that you want to get it. If you're going to get it Friday of this week or Monday of next week, that's probably like all you have left to grab it if you're going to be getting that one. It's going to offer a broad exposure to high yield stocks. On March 17th, iShare Mortgage Real Estate Investment Trust, REM, is the one to watch there. Um, Let me throw this one in there. Oh, goodness. It is doing double taps. Oh, too frequently. Too frequently am I posted. Um, this is going to be a fund that holds many of the individual mortgage REITs like AGNC, Armor Residential, and other BDCs in it in a slew of payments there. There it is. Now it's in your your YouTube section. So a slew of the real estate investment trusts and investment companies are going to have some key dates. Armor Realty Trust ADR and Mainstream Capital MAIN, uh, a popular monthly dividend paying BDC, are up on March 6th. And then Armor Residential ARR is another monthly payer with a very high yield, has a date on March 16th. So they are cutting it really, really close. And because of such closeness, you're going to have to decide which ones you're going to grab, whether you're going to split for the dividend rotation strategy or if you're going to go all in and buy multiple different shares in multiple different situations. Others include Gladstone Commercial and Industrial Specialist, STAG Industrial, which are cynical and traditional players. Then we're going to start talking about the energy sectors. Let me get some of these up here because YouTube is really getting frustrated with my ability to post all of these up here. I got to space them out as I get them up here so that you guys can kind of see what's going on. And you can write these down now. I'm putting them up on the screen specifically because even if the comment section isn't there on the replay, these will still be up on the screen for you if you come back looking for these stocks. These are some of the stocks that go across the bottom of the screen uh, during the show. So they're on the bottom of the screen for the 16 by 9 version, and they're going across the top of the screen for the 9 by 16 version. So you're able to see a lot of these shares most days out of the week so that you can get a good understanding of which ones that we follow. And the dates of which the ex dividend dates are, if you're trying to do buy and sell, you buy a few days before or a day or two before, and it's business days because you can't make any trades on the holidays, you can't make any trades on the weekends. Then you sell the day of or the next available trading day after. If you're doing buy and holds, these are the stocks that you can pay attention to and then re-up or advance your investment opportunities because you'll start seeing certain stocks go down uh, a few days before the ex dividend date, and that's fine because while they're down, you can buy in at a lower cost. And then when they go back up, you now have growth and you have the dividends because the dividend payout is not going to change just because the value of the stock change. So if the stock goes up, you gain growth on the stock and you also gain dividends on the payout. And that's one of the best parts about this. Now, in the energy sectors, Cord Energy on March 10th and shipping giant Zim Integrated Shipping, which has always been volatile. We caught that one on a good day earlier last year, not earlier, it was late last year. We caught it on the 2nd of August. We caught it when it gave out the most money it was giving for 2025, and we grabbed it on the dividend rotation. It's one of those things where if you want to get into it and you got a little extra cash on the side, you want to throw down on it right before during the declaration date, they tell you what the payout is. And if you see the payout and you want that payout, you buy into it before the ex dividend date, and then you ride the wave, and then you sell it after the ex dividend date, you get your payout, and then you put your money somewhere else. But these two stocks are going to be paying on, well, no, Cord Energy pays March 10th, but Zim Integrated Shipping pays on March 23rd. This represents plays on global economic activity. Now, Zim stock is going to be impacted by the tariffs. So when the market crashed, Zim stock would have been the one that would have been like, oh, dip, but it didn't last that long. Now, tech giants like Broadcom, this is going to be available on March 19th. I told you we had a lot of them come in. This is going to be a prime example of strong dividend growth with the tech sector. Finally, a classic income name that is Ultra Group, MO. This one is going to be on the calendar for March 25th. Now, today I told you we're covering 2 months. We're covering March and April. So I'm only going to give you each name once on the screen. But so our monthly payers, I'm not going to put those back up there a second time, but I am going to tell you about them. Now, April, we're going into the dividend rotation will continue through April with several familiar names paying out yet again. So with the ETFs, you're going to have your DIV stock and your QQQ stock making another appearance April 3rd and April 20th, respectfully. Monthly payers like Main Street Capital, which I don't recall putting up there before, uh, is going to be paying on April 8th. It's going to be clustered with um, Ellington Residential and Prospect Capital. Get these in there. And the monthly dividend companies itself, which this one is coined the monthly dividend company. This is like its slogan, uh, Realty Income. They have key dates at the end of the month between the 25th and the 31st. And these dates are being rolled out into the membership so that you can pay attention to those and keep track of them, because every week, either at the beginning of the week or the end of the week, it lets you know which stocks are up for ex dividend dates based on verified declarations. And then I double check towards the end of the month as we get closer to April. I double check for the April dates. So the ones that we have in March have, for the most part, been verified, at least for the first half of the month. So I strongly recommend that you go back and double check before you bid what your ex dividend dates are to make sure that no changes have occurred since you've seen today's show. Um, Finally, we're going to look at a tech stalwart known for its steady dividend increases, specifically, as I told you guys to grab it before the contract signing, Oracle. It's going to be one to watch for April 9th. Because since this will be their first quarter operating with TikTok, we want to be able to see what increases they're going to be having for their shareholders. So I want to make sure that, and when we get that information, I'm going to be able to tell you guys, man, look at the huge increase that Oracle had because they're running 170 million users on TikTok. This strategy isn't going to be without risks. The high yields from the mortgage real estate investment trust often comes with the volatility that's going to be tied with the interest rates. However, for investors looking to supplement their portfolios with income, these are the names and dates to keep on your radar. Because when we started talking about leveraging portfolio, when we started talking about leveraging assets at the top of the show, Michael was talking about chasing down apartment complexes over single family homes. If you have capital in a stock portfolio, you can leverage that capital to cover the deal and then have the portfolio's dividends pay for the loan. So they front you money backed by stocks. You take the stocks, buy you an apartment complex, use the apartment complex to allow you to leverage the apartment complex to buy another apartment complex. The stock portfolio can pay for itself if the dividends distributed from the stock portfolio's monthly payers is going to cover the cost of paying back the loan's monthly fees with or without interest, preferably with. So when you're looking at how much do you want, and they typically allow you once you're over 100,000 or over $200,000, they start allowing you 70% of your portfolio. Um, if you leverage 70% of your portfolio, that's like $70,000 out of every $100,000 that you're making. Now, if you're bringing in closer to 18% on your portfolio, between 15 and 18% from your portfolio, you're likely to be generating more money per month than the expected cost of the $70,000 that you leveraged off of your portfolio, or $140,000 that you leveraged off your $200,000 portfolio, which allows you to make the payments on your leverage loan and then be able to make the direct purchase on the property. Now, one of the other benefits of that is that if you bought the property cash up front, now you own the property. You have the property full of tenants. The property is generating revenue. You can then mortgage the property for enough money to pay off the leveraged uh, um, capital loan and utilize the difference to get yourself into another property. So while apartment complexes are a good way to go if you can afford it, as I was explaining to Michael, going from nothing to something, trying to jump from a single family home straight into a 62 unit house, apartment complex is not the way to go. Baby steps. You got to crawl before you walk. You have to be able to afford it before you can get it. So if you can get 5 or 10 houses that are generating a revenue, and then you can leverage all 5 or 10 houses that you don't live in any of them, and you leverage those to allow you to acquire that one apartment complex where you don't have to take any money out of your own pocket to get it. Your houses are generating revenue that's going to pay towards those mortgages. Your apartment complex is acquired and it is starting to generate revenue. It can aid in paying down the cost of the apartment complex. All of your tenants from your houses and your apartment complex will be paying for the debt. The difference between what they give you versus what you owe is going to be your profit. That's one of the things that leveraging assets does. So instead of just running a rat race of, I don't owe any debt from my business or myself, and I've got all of these assets, so I'm rich. No, you're not. You're still going to have to, in order to get more, you're going to have to sell something or you're going to have to leverage something to get money so that you can use that money to buy something that will make you more money, or you're going to have to, invest in something somewhere that is going to pay you back more than the money that you borrowed. Because you can take out a loan, and if you're taking out a loan like a mortgage that's at like 6 or 7%, and the money from the mortgage is going onto a brokerage account that's doing 15% after taxes, you're doubling your money. After you've paid off 100% of the mortgage, you still made a 7% profit every year. That's the stuff that I was making sure that I got through to everybody, is that it doesn't matter whether it's a big apartment complex or a small house. What matters is that if what you owe versus what you're making more than what you're spending, your return on investment is important. And your return on investment is not just, oh, well, I made $1 off of $1 million deal. Your return on investment typically feels good when it's more than 20% of what you started with. So if you're getting 120%, where all of your original down payment is returned to you and a 20% increase, you're doing a good job. Nothing less than 10% return on investment, or 110%. where you get back everything that you put in and you get back an additional 10%. When you start getting less than 10%, you need to start rethinking your situation. So if you get a $150,000 house and you get $15,000 back, you walked away with 10%. 10% more than what you invested. You broke even and came back with 10% more than what you invested. $1 million house should put 150 grand in your pocket. You're walking away with 10% out of everything that you paid for. If you walk away from $1 million property with $10,000, that's like 1%. You're not doing a good job. Doesn't matter if you can recoup your losses over a period of time, because again, risk is based off of the quantity of time it takes for you to get a return on your investment versus uh, how much you have to lock up in this deal for that period of time. Having $1 million locked up for 20 years might not be beneficial for you. Having $1 million locked up for 5 years might be okay if you don't need that $1 million. So it really depends on what your risk assessment is at. So, to wrap this all up, today's massive rebound was the market's forceful response to the narrative of fear that caused Monday's 822-point plunge. The sell off was triggered by a potent cocktail with a new 15% global tariff threat and a terrifying story that AI could destroy the very tech business models that have led the market for years. But today, a powerful counter narrative won out. Investors cheered by strong consumer confidence data, bet that those fears were overblown in the moment. They wagered that big tech companies will integrate AI, not be replaced by it. And they were encouraged by huge strategic wins like ADM's landmark deal with Meta. Most of all, they aggressively positioned themselves for a blockbuster earnings report from the AI kingmaker, Nvidia. The battle between these two stories, AI as a job killer versus AI as a productivity booster, is the central question for this particular market at this time. What happens next will depend on the data. The numbers and guidance from Nvidia's tomorrow decision will provide the next crucial piece of evidence and will likely set the tone for the market for the month to come. So, more than likely, I will see myself covering that not tomorrow, but maybe next Tuesday. However, in the event that somebody asks me about it, I will entertain it because tomorrow we're supposed to be talking about different countries around the world that we can invest in and potentially live in affordably. I have no problem with taking a segment out of tomorrow's show to verify positive or negative reviews from Nvidia and whether or not we will positively or negatively see impacts towards the market as a result of that review, and then continue with our discussion on which country we're going to, right? So, with that being said, I'm going to start by saying, ladies, as long as the situation doesn't make sense, I'm going to keep asking you, ladies, to make it make sense. So, ladies, please make it make sense. Fellas, I give you guys the information to help you guys become higher value men, not just with your finances, but with your decision making skills, so that you can prioritize the things in your life that are inside of your control and make changes in the things that you don't like. And then improving your standard of living, have the capabilities of navigating around the things that you cannot control. Now, ladies, while this is a male driven podcast from the male's perspective, you too can utilize the information that I give today in order to improve yourselves and make yourselves higher value women. First and foremost, figuring out where you want to be at with your 20-year plan, what it takes to get there, and then proactively putting forth the steps to get there. Keeping your eyes and ears open for potential suitors that have the mentality and skill set and drive to aid you in getting to your 20-year plan. Allows you to partner with an individual where y'all can merge your interests together and capitalize on joint efforts and reach your goals faster. One person can follow any one of the strategies that I've given and make themselves a millionaire inside of 20 years. But two people working together on the same goal can make themselves millionaires in 10 years. All it takes is fiscal responsibility. And it doesn't require you to live like you're homeless. It doesn't require you to live destitute. It just requires you to live fiscally responsible and not participate in unnecessary lifestyle creep simply because you have extra capital, right? Instead of having extra capital and buying extra stuff, if you have extra capital, you should invest that extra capital in generating more capital so that you don't have to work so hard to get the capital that covers your basic necessities. Remember this as well. The more extra money you have lying around, the more money you have to leverage towards something else that can make you more money. Millionaires become billionaires because they don't need the millions that they have. Okay. Individuals that get a bonus and spend the whole bonus partying like rock stars, drinks on the house, all this other stuff. You spent your principal. Now you're broke again. You've got to go back and earn your principal back. You must always invest your principal and then make it a priority in your life to only live on 30% or less of the interest. And why do I say live off of 30% or less of the interest? Because if you reinvest 50% of your interest paid back into your portfolio, you're guaranteeing your portfolio grows even if you stop working. Out of the remaining 50%, if your standard of living is 30%, you still have 20% to waste on bullshit. Expensive clothes, expensive cars, expensive travel, because it is 20% of the interest paid from your principal. Half of it gets reinvested, 30% gets divided, 20% gets wasted. You will never go broke. But if you're living off of your paycheck to paycheck, when you get furloughed, you stop getting paid. When you're living paycheck to paycheck, when AI fires you, you stop getting paid. When you're living paycheck to paycheck and your health doesn't support it anymore, or your age doesn't support it anymore, you're no longer getting paid. But if you've got money coming in from investment opportunities, checks being mailed to you just because you exist, you no longer have to stress about where your money's coming from. You no longer have to stress about how your bills are going to get paid. You can set up extra money in extra places and start having revolving capital, allow you to have profits on auto pay. And when you have profits on auto pay, now you don't have to think. The money automatically goes into your bank account for the first between the 1st and the 15th of March from all your dividends that were paid from the February. That money is sitting there for auto pay to pay for bills in April and May. You don't got to do nothing. You don't got to worry about waiting on the money to clear or anything like that. The bills aren't due for another 45 days. This is when you're able to travel the world thought free. You don't need a CPA or a personal accountant to push your money around if you automate your finances. This is where technology replaces humans. You can find yourself with less expenses paying a third party to watch your money when you can watch your own money. Then you can take your time, build a trust, put your money into the trust, have it set up on an automated feature where the person managing the trust is gonna just get a percentage of watching the money and make sure that it doesn't fuck up. But at the end of the day, their primary goal is to file taxes on any capital gains and pay debts on anything in the trust that has a debt to pay. Taxation, mortgages, stuff to that effect. Any properties that no longer qualify because it's no longer in a homestead position, you have to pay the property taxes on it. Any property that becomes a rental property, you have to pay the property taxes on it. So having that trustee over the trust to cover certain things like that, when you have a property manager that's taking care of the repairs and collecting the rent, and you have a trustee that's paying the property taxes and paying the taxes on the stock portfolio, you have two different people whose jobs do not intertwine. You don't have to worry about looting. They're guaranteed to pay you. You have your checks and balances. Your one phone call a day where you're being debriefed by somebody who tells you how much money you should have made versus how much money you actually made. Now your day is looking at the numbers. And if you've got somebody who that's their job, when you're making enough money to do these things, when that's their job, you're having breakfast and getting debriefed. That is a completely different observation than showing up and doing as you're told, being given extra work because the boss's homie is on a shift today, and being pissed off and frustrated and not being satisfied with the outcome of your life. Homestead position. Okay, so the homestead position that I'm talking about is If that is your primary residence, it is considered a homestead. If that is your primary residence, if you're certain cities and states across the country have different values for it, but they offer you a homestead tax credit. Um, you have to apply for that tax credit at the first quarter of the year. If you apply for and get approved of that tax credit, you don't you pay the difference. So if the tax credit covers all of the taxes owed on the property, you don't owe taxes. If the property has more taxes than the tax credit covers, you pay less taxes. One of the requirements is that has to be your primary residence, if not your second home, at best, not a rental property. Um, Also, if you have it in a trust and you are the primary resident of the homestead, you still can get the homestead credit. And even though it is in a trust, if you're managing the mortgage and the trust puts you in responsible for the mortgage, you can still, while the house is in a trust, cover the cost of the mortgage and then utilize that mortgage coverage for the property as your tax deductions towards your other assets, which makes building a trust just that much more important because while you're alive, there is a contract that says that if you die, somebody else will make sure your house goes to who you want it to go to, not who wants to take it from the person who you want it to go to. And if that person takes over your responsibilities and they're covering the mortgage and they're living in the house primarily, they get all the benefits of covering that bill. And if they're a beneficiary of taxable income, if they're covering a mortgage as a beneficiary of taxable income, that mortgage is a tax blanket towards the taxable income. Likewise, in these same situations, when you start setting up these trusts and you start making certain stipulations like all participants of the trust must have an active life insurance policy on themselves, you set yourself up for a benefit because if somebody passes away, the money goes to the trust because the trust is a beneficiary of the life insurance policy. Then that refills the trust, which allows for more capital to be generated, which allows for 50% to be reimbursed to the trust or refilled into the trust assets, and then the other 50% being divided between the beneficiaries and successor beneficiaries, which just like the Rockefellers allows for to build generational wealth. Certain stipulations upon marriage and divorce and accessibility to assets gained and lost. All of these things can be written into the contracts, written into the trust. And if these stipulations are written into the trust, somebody can't marry into a scenario where as a wife they're entitled to the trust, then divorce out of the marriage and still maintain their position in the trust. They would be forfeiting that position or as an ex getting a reduced amount, which would qualify as alimony. And if that qualifies as alimony, they're less likely to argue, I should be given more. Well, bitch, you're not entitled to what the fuck you're getting. So why ask for more? You should be grateful that you're contracted into guaranteed capital. You know what I mean? These are the ways where it doesn't matter if she invested in it or not. She's getting guaranteed payouts based off of her involvement. These are the ways that you can set yourself up, set your kids up, protect yourself from the marriages. And when you have that girlfriend contract we talked about before, you have the finance, the fiance contract that we talked about before. That, like Michael said, an addendum or article that is added to adding the last contract to the new contract, where the contracts aren't modifying each other, but they're reinforcing each other. And then getting to that prenup phase. By the time you get to the prenup phase, if you've got a person that's willing to date you under a girlfriend contract that limits her access to your resources, then you've got a girl that's willing to sign a prenup. And if you're willing to be a millionaire status and she's willing to be a millionaire status with you, then y'all can find yourselves in a position where y'all can become millionaires before she's too old to spend the money, and then she can have the lifestyle that she never thought that she could have, that she would have earned, and then she would not have to stress, and her last 25% of her life will be a piece of cake, you know. And that's one of the biggest aspects of um, the that's one of the biggest aspects of this particular dynamic, structuralizing these things. And if you're structuralizing these things while you're healthy and you're getting all of this stuff set up, Just like what happened with Will Smith, not Will Smith, Kobe Bryant. You never know. You could be healthy as an ox and then just not make it home. So if you set everything up, especially if you're setting it up under a revocable trust while you're alive as a primary grantor to setting everything up, by the time you pass away, whenever that may be, it is set in stone, and the next generation can come in and do certain things while being limited to other things, because once you pass, it becomes an irrevocable trust. So the irrevocable trust means that the rules can't be changed, but the assets and the beneficiaries can be added and removed for whatever reason, based on the stipulations of the rules of performance. And that's why you would be paying a trustee, a third party that has no interest in receiving the benefits from the trust, to manage the trust, to make sure that the other parties that are beneficiaries of the trust doesn't abuse the assets in the trust. And these are certain things like, instead of allowing your children to be spoiled, you can give them a limited asset and say, well, hey, I'm only going to give you $2,000 a month. You got to earn the rest. You have a $2,000 a month income and a guaranteed homestead. Live on one of the properties that doesn't have a tenant in it, and the other $2,000 a month, you're not paying mortgage, you're not paying rent, and that $2,000 a month should cover your everything else, right? And that gives them security. It gives them a little something, but if they want more than what you gave them, they got to earn that. So they're not partying like a rock star, because you can't go far with $2,000 a month, even if it's discretionary spending. You can't go far, you know, but you're able to help them build wealth. You can even do a scaling scenario. You can even do balloon payments where you start off in their younger years, offering them $2,000 a month to cover their standard of living, depending on what city and state that they're living in. And then when they start getting older, 40, 50, 60 years old, and start becoming financially responsible, you can up that to $5,000 a month or $6,000 a month, because they made it to those later ages. And now they're able to utilize that capital in a more fiscally responsible fashion. And if they're trying to get a passport in another country or something like that, get a visa in another country, that $6,000 a month income would grant them, in Japan and South Korea, a guaranteed digital nomad visa, because 75,000 is what you need, and 75,000 is like 5,500 a month income. And these things are have to be considered when you're looking at the payment structure that you're trying to build, as you get older, right? So you want to make sure that you figure out where you want to be at in life, and that's why I give you guys all of this information, because you can't know exactly where you're going to be at, but you know where you want to be at. And if you start building that now, you can get 90% of the stuff on paper, the way you think it should be on paper. Then when you take it to a real estate attorney, not a real estate attorney, an estate attorney, you've got your 50, 75, 100-page, 200-page trust document created. They just gotta put the legal jargon in there to cover the blanks. When they do that, that one consultation will set you up to the magnitude where whatever you pay, $500, $2,500, to set up a complex spendthrift trust, you're good to go. Now all you got to do is just add assets and add beneficiaries. And this is what I was telling y'all before. Uh, if any one group of individuals that did like the Rockefellers did and set it up where we all get somewhat of the same amount, but we all put all of our stuff in there, even if each one of us got like 5%, and there's 10 of us, that's 50% of the portfolio. But we're putting 100% of our money into this particular type of trust, and it's running 15 or 18% dividends, uh, and we're splitting that. You could see two, three, four, $500,000 a month across five people, or not a month, but like a year across five people, going into this account where over 10 years they didn't put several $1 million in principal plus the interest, which would have almost tripled it to $5 or $10 million, and each person getting 5% of $5 million is getting their annual salary and some. Where a handful, five people, five people getting 10% a person could do it. You could build a type of trust where Y'all don't have to worry about nothing. Cars are bought and paid for. Y'all could create a separate asset trust for vehicles. Cars are bought and paid for. You don't have to pay notes on them. Houses are bought and paid for. You don't got to pay notes on them. You've got a guaranteed income coming in from a trust. You don't got to worry about where your money's coming from. These stipulations put you in a position where you're guaranteed to show that you got money coming in from somewhere else, which helps with international travel. Because if your money is coming from a trust, it doesn't, and one of the best places to get your money from a trust is from a trust that has a no tax country. But if you start your very first trust in the United States and then you start your second trust from another country where, let's say, like Belarus or something like that, Barbados or something like that, and you set up a trust in a country that doesn't have residential taxes, and you set up that non-residential trust, your first trust could transfer revenue to your second trust, and your second trust can transfer the revenue to you. And since it's coming from the second trust, and the second trust isn't paying taxes on it in a non-tax state, when it hits you, you're not having to pay taxes because it's non-taxable income. It's non-taxed income from a non-tax country. But that requires your first trust to have it incorporated that upon the creation of X, Y, and Z trust, that trust is incorporated as the primary beneficiary of this trust, and all capital released is released to that trust. And then when you create that other trust, then that trust gets incorporated into the new trust. Then the new trust is going to select all of its beneficiaries and issue all the beneficiaries. That still could require you to spend another several $1,000s to create. But if you're making yourself a multimillionaire, that's what you're doing it for. You're setting it up to protect your wealth and protect your wealth for generations to come. Me and Steven are still going to be driving 20-year-old Toyotas. But we're going to be driving 20-year-old Toyotas 20 days out of the month, because every now and again we're going to get into something brand new and just go coasting. Right? So, with that being said, I want to thank you guys for coming to This and That. I'm your host, Xander, where we talk about this, that, and everything in between. And I will see you guys tomorrow night.
That's my personal command. I'm not landing on higher ground where excellence is found. My potential knows no bounds. just living, I'm manifesting my vision, cutting through limitations with surgical precision. My expectations are my compass, my respect is my shield to mediocrity and chaos. I will never yield.